Welcome. Good morning, good afternoon, good evening, and thank you guys once again for joining the 9 Innings Podcast, hosted by yours truly, Kevin Thompson, founder and CEO of 9 Innings Capital Group. Thank you guys for joining us. As I always say, subscribe to that channel. As I always say, go and get my book, MLB to CFP, live on Apple Books. If you have any questions, comments, concerns, you can always go to the website at 9inningscapitalgroup.com, or you can email us at 9innings@9icapgroup.com. You can listen to our YouTubes on the YouTube channel by typing in 9 Innings Capital Group Podcast. You can go to the iTunes channel and type in 9 Innings Capital Group as well, and subscribe to that channel to get our latest podcast. So, thank you guys for being loyal subscribers. Thank you guys for being loyal listeners. But today we're talking about something that's near and dear to my heart. People often think that the stock market is a casino. I don't agree with it, and I'm here to tell you today why I don't believe the stock market is a casino. Let's get it. So I was listening to a show that I enjoy. I used to listen to The Daily Show with Jon Stewart, and he has his new show out. And he did go after Jim Cramer one day, and he was talking about stocks and everything like that. And again, that's okay. I mean, that's all fun and games. That's what the media is designed to do. So now he has his new show, and he came back at the stock market once again by talking about certain things. And I enjoy listening to him. I think it's very it's entertaining, and he's a very smart individual, and I love him to death. But what I don't agree with is him saying the stock market is a casino. And the reason why I say that is because I'm going to give you, and I know it's going to be a biased opinion, because why? Well, how do we make our money? We make our money by investing other people's money using our quote-unquote modern portfolio theory approach, and making sure that we can increase people's earnings and basically their wealth by investing in what we call the stock market. So let's talk about some things that, if the stock market was a casino, why it is not. First and foremost, and I wrote some of these down because I want to be very clear. So let's talk about the stock market. The stock market is designed for us to participate in the growth of earnings of companies. It's designed for us to put money into certain companies, money into certain segments or asset classes, and we're going to participate not only in the company's growth, but also in our growth domestically or growth internationally based on what our investment thesis is at the time. So we all know the long-term time horizon or the long-term structure of markets, that over time, stocks generally outperform and you typically make money in the market. Now, that's not to say that there haven't been companies like that you've invested in that have gone belly up. There is a survivorship bias in the stock market. What you're not going to see in most of those indexes are the ones that basically went away, because they always get replaced by companies that are going to either just get replaced or ultimately do better in the future. These companies, like in the S&P 500, companies or in the NASDAQ and things like that, those are all the survivors, or the ones that are left and doing well. The ones that don't do well get replaced. So there's a survivorship bias in that regard. However, if you're buying individual stocks, there is what people call a casino bias in that regard. Now, when we're talking about casinos, let's talk about this. One, here's my question. Does a casino pay you a steady stream of income whether you win or lose your bet? What do I mean by that? If I buy company X and I buy company X for $10, and that company X goes from 10 to 5, yet it pays a dividend on their stock, and it doesn't cut their dividend by any means, They continue to pay that dividend quarterly or annually or semi-annual, however they have it designed. Is there a casino in America where I can give them money to play the game and they give me steady sources of income whether I win or lose? The answer is no. Casinos aren't designed that way. Casinos are you win or you lose, and you take what either you came with or you take your winnings or what have you. So it's not that. So therefore, part one is not a casino. Part two, does a casino provide you with the ability to give them money and participate in their overall winnings for that night? What do I mean by that? Can I go into Casino X, give them $1,000, and at the end of the night, they're going to take all the revenues from that night's winnings and give me a portion of those revenues, a portion of those earnings back? And the answer is no, unless you actually invest in casinos. But the answer is no. There's not a casino in America that I can walk into and say, hey, here's $1,000. At the end of the night, we're going to tally all the winnings up, and then ultimately you're going to give me a portion of those earnings back the very next day. It doesn't work that way. 3, does a casino give you voting rights just for playing? So if I go into a casino today and I give them money, do I have the right to vote in the operations of the company, or who's on the board or anything like that, or who's in the management team? The answer is no. You don't have that right. Another question. Does a casino provide you ownership as a player? If I go into a casino and I decide to play Texas Hold'em and I put my money down, do I have ownership in that casino? Do I have part ownership of that casino? Am I a shareholder? And the answer is no. I'm saying all this because a lot of people like to use the language that the market is a casino. And the market is not a casino. There are certain segments of the market that act like a casino. For example, in the commodities market right now, what happened? Prices got dislocated from the equilibrium price. War broke out between Ukraine and Russia. There's sanctions hit on Russia. Therefore, there's price discovery that's happened in markets. Price discovery. So what happens? Prices get a little bit inflated or prices go a little bit too low. But ultimately what happens? They always come back to a mean price where buyers and sellers can agree on that. The same thing in the wheat market right now. The same thing in the nickel market right now. What just happened? Prices blew out. So regulators had to come in and say, hey, this is getting out of control. Let's stop this. What's going on? There was an Asian company that was over-levered to the downside on the short side and margin calls. So they basically had to reconstruct, reevaluate, and make sure to get that market back to equilibrium. It's not there yet, but that's typically what happens in markets. Now, meme stocks. We saw what happened with meme stocks. Company XYZ decides to, Reddit investors come over the top, push the shorts higher. Guess what happens? The stock goes from $10 to $400 in a matter of months or a matter of 30-day trading. That is the casino-like nature of the stock market. When prices get dislocated from fair value, that happens in stock markets. And that's why when we talk about the efficient market theory, efficient markets happen longer term, but they can get dislocated from actual price in the near term. So are we in a weak form market? Are we in a strong form, semi-strong form, efficient market? Who knows? But the reality is markets, certain segments of it have casino-like tendencies, but the market in itself is not a casino. You're not going to go into the market, buy something, it go up 10,000% or 20,000% one day, and then you're going to sell it. It could happen. You could be the big winner, but the reality is this is not a casino in regards to all the things I've mentioned previously. You don't have ownership. You don't get dividends. In a casino, you either are a winner or you're a loser. Plain and simple. There are certain segments of the markets, like I mentioned, that have casino-like tendencies. Commodities have felt that way recently. Meme stocks have felt that way recently. A lot of the high valuation PE companies that have 30, 40, 50 times PEs on their companies have felt that way because they've been bid up in price due to low interest rates. What do we know is going to happen? When interest rates move higher, those companies will come down in price due to the risk-free nature of interest rates. The dividends or their future earnings on those companies must come down with higher interest rates. The valuations must come down with higher interest rates. It needs to be understood. I wanted to talk about this today because I get very upset when pundits or people come onto TV and tell people that that markets are nothing but a casino, which is not the case. People lose faith in global markets. People lose faith in the overall structure of capital markets. And I just want to clear the air of saying that markets are not a casino. However, they do have tendencies in certain segments when prices go far away from fair value. And it happens. I appreciate you guys' time. As always, please don't hesitate to subscribe to the channel. Get my book, MLB to CFP. As you know, we are here to do what? Educate, empower, and engage. And today we're talking about markets and casinos and how they differ. The moral of the story today is that the stock market is something that provides you the ability to participate in growth domestically, growth internationally, and growth in individual companies if you so choose, and to preserve or get additional appreciation on your wealth. Is there a chance you could go down and lose money? Absolutely. Absolutely. But what do we know? Over the long term, what happens? If I buy stock XYZ or index XYZ, over the long term, you tend to have higher highs and higher markets over that time, especially when we're talking about indexing. If you're not a stock picker, because stock pickers can generally win or lose, but most people are moving towards exchange traded funds and index funds that allow them to participate in the overall growth of our economy and stay indexed where they don't have to worry about the winners and losers in certain markets. Again, thank you guys for joining us. I appreciate your time. This is Kevin Thompson on the 9 Innings Podcast. We appreciate it. Thank you for subscribing. We'll have more coming out. Thank you and stay safe.